Okay, welcome back to Not Financial Advice. Please like the video and subscribe to the channel. And if you're new here, we've recently gone past 100 subscribers. And one of the things I like to offer here on this channel is an offer that I'll go ahead and review any stock that you'd like for me to take a look at. And so I really appreciate all of the subscribers' support and a lot of demand for me to take a look at different stocks that you guys are interested in. So it's certainly an honor. So what we're going to do today is we're going to be taking a look at four stocks. We're going to be doing sort of a speed run. And this is actually going to be neat because this would be the way that I would scan a company that I've just come across. But I will go ahead and give everyone my estimate of the fair value on most of these stocks here right after this.
You need to diversify your bonds.
The only problem you're gonna have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
We can see different metrics here, high-level metrics on GlobalFoundries. So it's a $33 billion market cap company, which means it's a large cap company. It trades at a 23 PE ratio, which is not super remarkable one way or the other. It looks like it has a negative free cash flow yield, so immediately we don't like seeing that. And then we can see that it has about the same amount in cash as well as debt. Actually a little bit of a net cash position, $800 million. So that's pretty good. And so we're going to run through this really in a similar way as you may have seen in some of my videos in the past, but we're going to sort of do this on one take. So what we can see here on GFS is sort of a weird revenue chart. Um, Going from 18 to 19, it went down, and it's understandable that it went down in 20 and now it's going up. But this is just sort of a weird looking revenue chart. This is a semiconductor company, by the way. It's actually a foundry. So um, there aren't that many foundries, people that make chips in the world. Intel is one, TSM is one, and I guess GFS is one as well. But just looking at this chart and looking at some analyst projections for the growth of this industry, we can see that they've averaged 5.5% revenue growth over the last 5 years. We're going to be using our opinion of that number when we make an assumption about future growth to get a rough DCF estimate on this company. So this will be a check mark on revenue because it is up and to the right. Moving forward on free cash flow, I'm going to give this a big red X. So a huge year of negative free cash flow, and then some improvement, but then another really big year of negative free cash flow means this company just really isn't producing a lot of free cash flow. That's that. Let's also take a look at shares outstanding. Um, they're slightly issuing shares, slightly diluting, but not by a whole lot. So this will sort of be a neutral or a pass. Let's take a look at ratios for GFS, the semiconductor foundry. So 8% return on capital employed. That would be pretty good if it wasn't for this negative number and this huge negative number. So this is going to be a red X on returns on capital employed. Margins look horrible too. Red X there. Cash and debt. Let's take a look at it. They have steady debt and growing cash, so I'll give it a check mark. So going down here, we can just see they're in the semiconductor space. GlobalFoundries operates a semiconductor foundry worldwide. Integrated circuits, which enable various electronic devices that are pervasive. Company manufactures a range of semiconductor devices, as well as offers mainstream wafer fabrication services and technology. So I'm not a bajillion percent clear on this, but I sort of have the sense that this might be the type of company that's just making those more generic chips, things that might go in like alarm clocks or things of that nature. Based on how poor these numbers look, I don't care to look into it any further. With that being said, it's a $60 stock. let's get back over here and see if we can figure out what the value of this stock is. Before we do that, let's take a look at the price chart. And this is a weird looking chart. So I'm about to break this down for y'all, but I'll ask you to like the video and subscribe to the channel if you haven't already. This is a very abnormal stock price chart. I don't like it. I don't like the way that this chart looks at all. Never have really seen a chart like this before. So with that in mind, a $60 stock, it's going to be based on the free cash flow, because they had, some years with 400 million in free cash flow, but a year with negative a billion free cash flow, etc. Averaging those out, it's really just a meager amount of free cash flow. Numbers lifted from Qualtrim here and here, as well as here. These projections are based on my research and looking at the company. 10% growth rate, $60 stock, worth $3. Boo. Hate it. I hate it. So sorry if that was bad news to anyone, but let's move forward. So now we're going to be looking at a company called AECOM, and let's see what AECOM is. So they're in the engineering and construction field within industrials. And so this one is going to be in the probably too hard bucket for me, maybe, but they provide professional infrastructure consulting services for governments, businesses, and organizations all over the world through three segments: Americas, International, and AECOM Capital. They offer planning, consulting, architectural, and engineer design services, but they also develop real estate projects, offer construction services, infrastructure services, transportation, energy, water, government facilities, environmental. It's just a lot. It's just a lot. So if you own this company and you're a civil engineer, that might be okay if you feel like you can understand this. But let's go through the high level metrics here on Qualtrim. And what we're going to be seeing is that this is between a mid and a large cap company, not a very commonly known company, uh, seemingly reasonable, forward PE of 20. We do see that they have free cash flow, 2.25%. That's great. Cash and debt looks okay. They have about $2 billion in debt and about $1.3 billion in cash. Seems okay. They have a meager payout, meager dividend yield rather, of 0.95%, but the payout ratio is way, 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 way too high, 90%. And so this seems to be a little bit of a conglomerate. They do stuff in real estate, but I don't think they're a REIT, so I don't like how high that payout ratio is. Let's go through here and see our check marks versus our X marks. So revenue on this company, whatever that is, I don't like it. It's been said in the past, buy a company that even an idiot could run, because at some point they will. And so I don't know what the excuse or the explanation for is with this. This sort of looks like divestitures and acquisitions, possibly, and more divestitures. But I don't like how inconsistent this chart is. With that being said, over the last 10 years, revenue is up 11.2%. I will give it a tepid check mark, and we're going to move forward, but I don't like the way that that chart looks. Let's also take a look at free cash flow. I don't like how inconsistent it is, but it is up and to the right. Free cash flow is growing, so I'll give it a check mark. We're also going to take a look at cash and debt. Debt is going down and cash is going up. That's a pretty strong check mark. Let's check in on the dividends and see if they've ever cut dividends before. So they haven't. They have a dividend they're paying and it's rising, but because of that payout ratio of around 90%, I'm actually going to give it an X mark. Don't feel that it's a low yield, which is unsafe. So I'm not going for that. Shares outstanding, X mark, it's all over the place and they're issuing shares. High on a relative PE valuation, that's going to be an X mark. Ratios, around 10%, but their margin is going down. So X on the margin, check on the return on capital employed. So this is a $93 stock. $93 stock. I have our numbers here. So a little bit of behind the scenes action. We're going to go ahead and plug those in. This was the average of 5 years that I came up with on free cash flow. The most recent as of the most recent quarter, cash and debt. Sometimes it fluctuates a little bit from this area up here, but using the numbers on Qualtrim for the most recent quarter, 140 shares outstanding. Based on the sector that they're in and looking at their growth rate, which is I think was around 11%, but based on the sector they're in and analyst projections about the growth of this company, let me just do a quick spot check. I had 140 million shares to make sure I'm not mixed up by any means, and I'm not. So $92 stock, AECOM, $93 stock, price value, $63. I think it's overpriced. So now we're going to move on to the next thing. So like the video and subscribe to the channel if you haven't already. What I will say is this does look like a fairly bullish chart. And so if the growth numbers are going to be higher than what I projected, it's close enough in the range that if I'm wrong, it could be fairly valued. And I do see a really bullish chart on here. But for anyone who owns this or is considering owning this, everything is always worth a second look. So thanks for bringing it to me. We're going to now take a look over here at a company called Safehold Inc. And I have not heard of any of these companies. I think I might have heard of GFS before. So, thanks to the subscribers for bringing these companies to my attention. And for any of you out there, if there's a stock you'd like for me to take a look at, just feel free to drop its ticker symbol in the comment section below. And I can usually get back to you within about a day and a half. Looking at Safehold here on Qualtrim, it's a it's a small cap. What am I doing here? It's either a small cap or a mid cap. It has a reasonable PE ratio of 16. Negative free cash flow yield. Don't like that. Now this one's going to be a REIT. They have a lot of debt and not as much cash. REITs typically carry a lot of debt, and the way the structure is set up, that's not really the end of the world. What I don't like here is a 3% dividend payout, and they're either taking on debt or issuing shares to pay for this dividend yield. It's a minus 65% payout ratio. So this dividend on this company seemingly is not safe. Now, what I will say is that this is a REIT, and so I don't typically hold or analyze anything that's a commodity. So what that means is something like this.
Goodbye to me tonight.
Start the fire, buddy!
Come on, man, play something from a stranger!
We strictly do 80s Joel music, sir.
And why you needed me to. 80s Billy Joel doo-wop sucks!
Hey, listen, mother, we only sing 80s Joel. So take your skank hooker wife and get the out of here.
I don't do oil per se. I have like $150 in an energy ETF, but I don't hold crypto coins themselves. I don't like commodities. I like companies. I like companies that produce useful products and can pay me a dividend. And in this sense, it gets a little bit blurry. A REIT could be that, but it's commoditized. And so I don't mess with anything that's a commodity, which also means when we're looking at REITs, it's not appropriate to value this using discounted free cash flow. At the moment, I'm able to value companies based on free cash flow or based on dividends. There's a metric called AFFO that is used to value REITs, and I don't know enough to comfortably share that with you. So with that being said, when I look at this completely negative free cash flow, I would just stop looking at this company right here. Okay, so I'm not going to attempt to value it because it's not worth anyone's time. With that being said, the revenue chart looks horrible. This looks bad. It looks not great. It looks just sort of very inconsistent. returns on capital employed aren't great. REITs do issue shares pretty much every year, and that's part of the structure. That's not a bad thing when it comes to REITs. But yeah, this is just a REIT that unlocks the value beneath the land of people who own buildings. So it just seems like a company that's trying to be too smart. So it's a $23 stock. No idea what it's worth. I would never buy this. So we can take a look at its price chart here. It's not a bad looking chart necessarily, but I don't spend a lot of time looking at the charts for REITs. So let me ask you to like the video and subscribe to the channel if you haven't already. But what I will do is I'll sort of do a relative valuation versus a company vetted by persons smarter than me. So this is a REIT called Vici. So they own essentially the Las Vegas Strip. What we can see here, and this is what you're going to want to look for when you're looking at REITs. So if there's another REIT that you'd like for me to look at, feel free to ask me and I'll do a video on it or incorporate it in a video. Or you could get Qualdrum yourself so you have access to these tools. Either way's great. But what we can see here is, as opposed to Safe REIT, Vici REIT has a dividend payout of 5.2%, which is safe, around 65%. Usually the cutoff for payout ratio is 60%, but with REITs, it can be higher. I think up to 80 or 90 is okay, just based on the tax structure. They have a lot of debt, but they also have a decent amount of cash. That's typical for REITs, but we can actually see a positive free cash flow yield here. And you can just see how they have free cash flow that's going up into the right, revenue that's going up into the right. More consistency in their returns on capital employed. Shares outstanding rise, which is normal for REITs. So this is what a REIT should look like. It's not what Safe looks like, and that's why I didn't spend more time on it. So thank you so much for sending that over. Sorry for the bad news. Lastly, we're going to be taking a look at, it's not Fortnite. It's not the game Fortnite. It's Fortinet. Fortinet. So this is cybersecurity. Okay. Cybersecurity. Let's take a quick look down here. So they provide broad, integrated, automatic cybersecurity solutions around the world. Intrusion protection, anti-malware, VPNs. Overall, a fairly confusing company, it seems. But if you're a tech person, um, or you feel comfortable with this, you just feel there's a strong trend for cybersecurity in the next 10 years, which I actually do. It definitely could be one that you might consider. So it's a $58 stock. It's $56 stock more closely. Let's run through these metrics. $45 billion market cap, 35 PE, which may or may not be reasonable. Strong 4% free cash flow yield, like that. I'm liking the way this looks more than anything else. Cash is 3 billion, debt is 1 billion. That's great. So revenue is up and to the right over the last 10 years, growing at 22%. So this is a check mark. Note in the last 2 years, there's been a deceleration to 15%. Free cash flow looks absolutely fantastic. Enthusiastic check mark here for me as well. Looking at cash and debt, they have a track record of not keeping debt off their books, and it looks like they're, the ratios all look appropriate, about 1/3 debt to cash. So check mark on cash and debt for this Fortnite company. Ratios. So massive return on capital employed, 31%, 18%, 24%, 14%. So the average is going to be over 15. It's a big check mark. And it seems like it's just moving in the right direction here. So I really like the way that looks. Relative valuation is also about where it usually is. So that's going to be a check mark. It's below its super high peaks. And so we have a $58 stock. Let's take a look at the price chart. This is a pretty good looking chart to me. $59 stock rather. So we'll get back over here, a little bit more behind the scenes action as I'm plugging in the numbers to get an estimate on Fortinet cybersecurity. I'll ask you to like the video and subscribe to the channel. And we're going to be able to see here what the fair value is for this company. So popping these numbers in, I have it right here. So based on the trajectory of the company, looking at economists' estimates for the growth of the cybersecurity industry, I'm putting in some conservative growth projections. As I sit here and think about it, they may be too low, so I'll do a second scenario. So these are the numbers. Cash is 2.2, debt is 990. Average on the free cash flow is 791 million. Let me come over to Qualtrum, just spot check, make sure I haven't confused anything. So cash and debt, I had 221. Okay, yep, and then debt I had 990. Okay, that's right. So $59 stock. Fortinet, $59 stock. Value based on assumption number 1 is $28. So it looks like it's sort of a multiple thing. Anything with cybersecurity is super hot right now.
Hansel, so hot right now. Hansel.
I would like to take this opportunity. People, I'd like to announce my retirement from the male modeling profession.
Especially in a 2023, technology growth bull market type situation. And so this really checks a lot of boxes on fundamentals. This definitely seems to be a pretty high quality company. So let's go in here and let's just give them a higher projection on their revenue growth. See where it comes out. Comes out at $33. So this one is overvalued still, I think. So that's my opinion on that. With that being said, if there are any companies that you would like for me to take a look at for you, you can just feel free to drop the ticker symbol in the comments below, and we'll wind down here. This is New Year's Eve, recorded on New Year's Eve 2023. The market has returned 24.8% this year. A great year for the market and for investors. Thanks for stopping by. Make sure to subscribe and like the channel on the way out, and I will see you on the next one.